Good afternoon, everyone. This is the Office of Consumer Credit Commissioners stakeholder meeting to discuss upcoming rules for commercial sales-based financing. My name is Matt Nance, and I'm the OCCC's General Counsel. I'm joined by other members of the OCCC staff, including Commissioner Leslie Pettyjohn, Director of Licensing, Finance, and Human Resources, Moran Diamond, Deputy Director of Consumer Protection, Carl Hubenthal, and finally, Assistant General Counsel Audrey Spalding and Paralegal Nico Fisher, who are acting as our meeting organizers. I have a couple quick housekeeping items before I turn it over to the Commissioner for opening remarks. So we're holding this meeting through an online webinar, and our webinar platform is GoToWebinar. Some of you might be listening on your phones, some may be watching on your computers, and some may be doing both. For those of you watching on your computer, there's a questions window where you can submit comments to staff. And if you have technical questions about using the webinar, you can type them in that area and Nico will try to answer those questions. With that, I'll turn it over to the head of our agency, Consumer Credit Commissioner Leslie Pettyjohn, for some opening remarks.
Thank you, Matt. Good afternoon, everyone, and thank you for joining us today. As Matt said, my name is Leslie Pettyjohn. I'd first like to begin by welcoming each of you to this important session. We're especially grateful to have such a diverse and engaged group of stakeholders with us, many of whom will soon be directly impacted by the new registration requirements introduced under HB 700. We've had an especially strong level of interest to our advance notice of proposed rulemaking. Today's webinar marks the beginning of an ongoing dialogue. As we move toward implementing this new regulatory framework, your insights, questions, and concerns are not only welcome, they're essential. Our primary focus today is to hear from you as we explore how best to formulate future rules to implement House Bill 700, and in particular to identify and address misleading and unfair practices within this evolving landscape. We recognize that compliance is not just about rules, it's about clarity, fairness, and trust. That's why this session is designed not as a lecture, but as a conversation. We'll walk through the key elements of the law, outline what the registration will entail at a high level, and most importantly, open the floor for your feedback on how we can work together to ensure transparency and accountability. So whether you're here representing an organization, a professional community, or your own interest, your voice matters. We're committed to building a process that is informed, inclusive, and responsive to the realities that you, the industry, and its consumers face. And with that, let's get started. I'll hand it back over to Matt Nance, who will guide us through today's session.
Yes, thank you. And I do want to second the Commissioner's welcome and thank you to everyone for joining us. Getting input from stakeholders is a really important part of our rulemaking process, and these meetings help us make sure we produce the best rules possible. So the material that we'll be discussing is in an advance notice of rulemaking that we've posted on the OCCC's webpage for recent and upcoming rules. On that webpage, you can see the draft advance notice you can see the advance notice by clicking on the link for commercial sales-based financing rules. So I'd like to do a high-level summary of our advance notice, and then I'll lay out the tentative timeline for the rules, and then you'll have a chance to provide comments. So the product and regulated area that we're talking about is called commercial sales-based financing. And what is commercial sales-based financing? It's defined in House Bill 700, passed by the Texas legislature earlier this year. And it's a type of financing where the recipient repays financing as a percentage of sales or revenue. Either payment amounts can increase or decrease based on sales or revenue, or there's a fixed payment mechanism adjusting payments to a percentage of sales or revenue. I'd like to say a little bit about HB 700, the legislation that these rules would implement. So there is a registration requirement. The bill requires providers and brokers of commercial sales-based financing to register with the OCCC, and this will be a new area of regulation for our agency. There are exemptions for banks, credit unions, certain technology providers, transactions secured by real property, transactions extended to motor vehicle dealers and rental companies, and certain other transactions. Disclosures. So disclosures are required for transactions less than $1 million, including the total amount of financing, disbursement amount, finance charge, repayment amount, payment amounts, and the period for payments to equal the repayment amount. There are some other prohibitions. So the bill provides that confessions of judgment and similar provisions are void and unenforceable, and the bill prohibits automatically debiting a recipient's deposit account unless the provider holds a perfected security interest in the account with first priority. Finally, on rulemaking and enforcement, the bill authorizes the OCCC to administer, implement, and enforce the new chapter of the Texas Finance Code. It authorizes the OCCC's oversight body, the Texas Finance Commission, to adopt rules to administer the chapter, including rules on practices considered unlawful, unfair, deceptive, or abusive, which includes practices taking unreasonable advantage of a recipient's lack of understanding, as well as some other practices described in the bill. The bill prohibits the Finance Commission from setting a maximum APR, finance charge, or fee for a commercial sales-based financing transaction. HB 700 generally went into effect on September 1st, 2025. It provides that no later than September 1st, 2026, the Finance Commission will adopt implementing rules and requires providers and brokers to register with the OCCC no later than December 31st, 2026. So that's kind of a high-level summary of HB 700. And now I'll move to the anticipated rulemaking. So the first key area that we've identified for this rule action is registration. We anticipate the registration will be through the Nationwide Multi-State Licensing System, or NMLS. The registrations will be effective for a one-year period from January 1st to December 31st, and the registrations and renewals will be subject to a fee for administering the program. The next key area of rulemaking that we are looking at as we get ready to prepare these rules is some sort of rule or rules that would implement the prohibition on what we've broadly called unfair and misleading practices, or more specifically that HB 700 describes as unlawful, unfair, deceptive, and abusive acts or practices, which include practices causing substantial injury, misleading practices, and practices taking advantage of lack of understanding. As we prepare these rules, these could include prohibitions on things like false, misleading, or inaccurate advertisements, solicitations, disclosures, or contract language, a provider or broker's failure to perform contracted for services or inaccurate descriptions of contracted for services, charging fees or other amounts that were not specifically disclosed and contracted for, waivers of statutory rights, foreclosing on collateral without complying with applicable requirements, such as Chapter 9 of the Texas Business and Commerce Code, improperly characterizing a transaction as a commercial transaction when the advance funds will be used for individual, family, or household purposes, and a device or subterfuge to evade regulatory requirements. This is an area we're particularly interested in stakeholder feedback on as we work to put together a future draft of the rules to get additional comment on. So finally, the third key area of rulemaking that we're looking at would be additional rules on administration and enforcement. This could include things like authority to conduct an investigation on receiving a complaint or other reasonable cause to believe that a provider or broker is violating the new law, a requirement for providers and brokers to make records available for inspection and to respond to requests for information, a requirement to maintain transaction records, including contracts, required disclosures, account histories, and payment records for a specified period, a requirement to maintain updated contact information and to provide advance notice of changes to registration information to the OCCC, authority for the OCCC to issue enforcement orders, including injunctions, restitution orders, administrative penalty orders, and orders to suspend or revoke a registration, and possibly a requirement to include information in contracts on how a recipient may file a complaint with the OCCC. So that's kind of a high-level summary of the issues we are looking at as we prepare to draft rules. Here's a tentative timeline for the rules. You see that we're requesting informal comments on our advance notice by tomorrow, November 20th. We would plan to send a pre-comment draft or possibly drafts of the rules in December or January. We would propose the rules at the Finance Commission's February 2026 meeting. There would be an official comment period during the month of March, and we'd present the rules for adoption no later than the Finance Commission's August 2026 meeting. So we anticipate this is not the last opportunity for comments from stakeholders. There would likely be at least one informal pre-comment period after we send out a draft of the rules, and then an official comment period following the Finance Commission's formal proposal of the rules before they are finally adopted. So at least one more opportunity for informal comments, and then an opportunity for official comments before the rules are finally adopted. This is, of course, a tentative timeline. All of this is subject to the Finance Commission's approval of the rules. But as HB 700 directs the Finance Commission to adopt rules no later than September 1st, we'd be looking at presenting the rules for adoption by the Finance Commission no later than their August 2026 meeting. So with that, I've summarized our advance notice of rulemaking, and I will open things up to comments. There are two ways to provide your feedback through this webinar. First, you can type your comment out and send it to us through the webinar's question feature, or if you're on a computer with a mic, there should be a function allowing you to raise your hand. Also, if you have a longer written question, please feel free to type a quick message into the question field and go to webinar explaining that you have a longer message, and we can wait and allow you to type in your longer message. So Audrey and Nico, do we have any hand raises or written questions or comments through the webinar?
It appears we have a hand raise from Solomon Goldman. I'm going to unmute him.
All right, thank you.
Mr. Goldman, you can unmute and make your comment.
Yeah, hello?
Yes,
We can hear you.
So my question is as follows regarding a part of the bill. When it comes to UCCs being the perfected first position, what is the law regarding the prior UCC notices before the law went into effect?
Oh, okay. So I understand. Are you asking about transactions, sales-based financing transactions that happen after September 1st, 2025, but there are existing liens that were in effect before September 1st, 2025, or am I misunderstanding your question?
Correct, that is the question.
Okay, yeah, interesting question about the effective date of the law. And you know, I think if I'm reading the bill correctly, that it applies to transactions entered on or after September 1st of 2025, and you would look at liens that are in effect as of the date of the transaction for all transactions after September 1st, 2025. Now that might we might be limited in how we can fully address that by rule. I'm open to feedback from stakeholders if stakeholders have kind of a different understanding. I should say that our rules can apply to, they have an effective date that goes into effect after they are adopted. So our rules apply prospectively. But yeah, if stakeholders have feedback on how, like, should the rules specify when requirements apply, we're definitely open to feedback on that. We have a question. I see a question in the chat from Danny J. Are we allowed to do a cash advance in the state of Texas? That's kind of a broad question. I might need a little more detail on what type of cash advance is being asked about. This new bill is for a specific type of advance where repayment is based. These are advances to commercial businesses, and repayment is based on the sales or revenue of that business. Cash advances generally can implicate a lot of different laws under the Texas Finance Code, depending on whether they're made to consumers or businesses. So we might need a little more detail to address that question.
Matt, we have another hand raise from Robert Zadek.
Okay.
Mr. Zadek, you should be able to unmute yourself and speak now.
I am. Thank you so much. I have two questions, and they are unrelated to each other. The first question is on the standard of, and I'm doing it from memory because the picture isn't in front of me anymore, about misleading or deceptive practices. Is the test objective or subjective? That is to say, is it a reasonable person would be misled, or the particular client or borrower was misled, and the problem was the borrower didn't have good comprehension, but the statement itself was not per se misleading? That's my first question. And if you want to, you can answer that question, then I'll go to the second question, or I can give you both, whatever you prefer.
Okay, I think we could address that first question first. So the legislation doesn't necessarily use the terms objective or subjective. It does talk about the rules identifying specific practices. And I think we would look at practices that are possible to identify in transactions. That might be what you're calling objective, in the sense that the practices, you can determine the practices either by looking at the face of an agreement or comparing the face of the agreement to the practices of the company. But I don't know that the legislation necessarily is limited to objective practices per se. I'm not sure that it uses that terminology, but we would be looking at what are specific practices that could be identified.
So then it would be impossible for a supplier of the services or the counsel to the supplier to know for sure whether or not a practice flunks the test, because there's just no way to know. It's what the OCCC determines. So it's very hard for somebody who's attempting to comply to know if they're actually complying until there's an actual finding. Is that correct?
I am not sure I'd characterize it that way. I think like I said, we're looking at having rules that identify specific practices where stakeholders can understand the rules and understand that they're going to be in compliance in advance. And that's part of the reason we try to get stakeholder feedback, is to make sure we're producing rules that can be understood and complied with in advance. And that's why we seek stakeholder feedback to ensure that. So we don't want to produce rules that people don't know whether they're in compliance with. So we like I said, we welcome feedback on ensuring that we have clear rules that these businesses can follow.
And the second question, sorry, the unrelated, is there's a standard, of course, in the statute about what a supplier of these services can do, and that they have to have a first lien. Does the supplier of the services have to have a first lien on all assets or only accounts? What do those words mean when you apply them to the assets of a business?
Okay, very good question. And this is something we may be taking a look at addressing in the rules. And if stakeholders, have feedback about how to address that, we welcome the feedback. But kind of on an initial reading, the section you're talking about says, in order to take automatic debits from a deposit account, the provider needs to have a perfected first priority security interest in the account. And I think my initial reading of that provision is that that's referring to a security interest in that account, the same account we're talking about taking automatic debits from. But if folks have a different reading of that, we would welcome that being addressed in informal comments, because we want to make sure we get the interpretation of that section correct.
So it's the first perfected security interest only in the deposit account, which is the target for the automatic debits.
I think that's what that section says, but if folks read that section differently, we welcome feedback on that.
Okay, thank you.
Sure. Okay, we have a couple questions from the chat. Follow up from Danny J, following up on the first question, asking about merchant cash advances for small businesses. So are we allowed to do those cash advances? Well, if sometimes we've heard this sales-based financing referred to as a merchant cash advance. So when you say merchant cash advance, you're referring to this commercial sales-based financing. Then in order to provide those advances, business would need to comply with HB 700 and comply with these rules once they are in effect and obtain a registration with our office. And okay, we have another written question from Zalman Notik. Is this presentation being recorded? Regarding the current law, would it be okay to allow a merchant to set up their own ACH debits by logging into a portal where they can log in at any time to turn off and on the debits? So is this presentation being recorded? Yes, it is. And we will be planning to post a video to the OCCC's webpage for recent and upcoming rules. Would it be okay to allow a merchant to set up their own ACH debits by logging into a portal? Possibly. I think if stakeholders have feedback on that and whether the rules should address that, we would welcome that, but possibly this could be accomplished if it is consistent with that requirement to have a right. The statute says in order to have an automatic debit of a deposit account, there needs to be a perfected first priority lien on the account. So if a provider can do it consistently with that requirement, there might be a way to have a merchant set up ACH debits. Okay, we have a written question from Alan Pollock. Just to confirm, the law came into effect on 9/1, and what is being contemplated here is guidance as to the implementation of the already in effect law. So I would agree with that. The HB 700, the statute, it might help to distinguish between the statute and the rules. So the statute passed by the legislature, HB 700, went into effect on September 1st, 2025. We're talking about future rulemaking that would implement HB 700, which is already in effect. Okay, we have a question from Jacob Neiman. The new ACH prohibition in Texas law provides, and then there's a quotation of the automatic debit requirement from HB 700. The question is, does this prohibit a mechanism that causes the debits to be made automatically while permitting a provider to manually debit the account each day, i.e. setting up a new request each day? Or does this prohibit any use of the ACH system for debiting, given that it stands for Automated Clearinghouse? Is automatically debiting a term of art that refers to any form of electronic debiting, and therefore a prohibition even against a funder doing so manually each day? And that also relates to another question. Would the OCCC be able to provide guidance on the definition of automatic payment? That can be read very broadly. Yes, so this is getting to the definition of automatic debit. I think we are interested in getting feedback on that. I could see the rules having a place in defining what is an automatic debit, as that term's not defined in the statute. And possibly there might be some sort of distinction between automatic or recurring debits and manually set up debits, if that makes sense. But I think that is a possible area the rules could address. And if stakeholders have thoughts for a definition of automatic debit, especially if you have, support or other related areas where a court or the legislature or another rulemaking body has defined automatic debits that could be used as guidance for that, we would definitely be interested in that, because I think that is a possible area where the rules could specify requirements. It sounds like we also have 2 hand raises, so I'll turn it over to Audrey to address those.
Mr. Gibbons, are you intending to still make a comment? You had your hand raised and now it's gone.
Yeah, well, I think my question, it related to the definition of what an account is for that automated clearinghouse, the automatic debit prohibition. And so I think there's been some questions regarding whether that account means the deposit account and therefore you have to have a control agreement, or whether that means account is in the accounts receivable that are being purchased. But if I understood Nathan correctly, that's going to be an area that the OCCC is going to need comments and guidance from stakeholders in. And so the answer is just not clear right now. If I misunderstood that, that was my question.
No, I think that's a great question. Very closely related to the automatic debit concept and the concept of what there's a lien in. And yes, I would agree. That is a possible area the rules could address and include some guidance on. If stakeholders have thoughts on that, we encourage feedback on it.
Okay, thank you, because it's just you know, deposit account and account, and those are all defined terms under the UCC. So there's a lot of confusion in the industry about that.
Okay.
Okay, thank you, Mr. Gibbons. I just wanted to ensure your comment got heard. The next one we have is from Scott Plato. Scott, you're unmuted. And I don't think he is here anymore.
Okay.
Let me try one more time, Matt. I see him at the bottom of my list now. Mr. Plato, are you there? It appears I'm having some difficulty getting him unmuted properly. Let's move on to the next written,
Sure.
and I'll see if I can troubleshoot.
Yeah, we can address a couple written questions and then try to come back to Mr. Plato. We have a written question from Ashley Word. So, merchant cash advances given to business owners based on revenue. Many lenders have pivoted after this ruling in September, and they are offering a sales-based funding product, but they've changed their billing. How are these being legally dispersed, and what are the rules on the repayment now for Texas-based businesses securing these MCAs? Okay, so good question. So House Bill 700 went into effect in September. If I understand the question correctly, it's about what requirements apply to those transactions today. So today, those transactions, if they meet those definitions in the bill, are subject to the bill's requirements and prohibitions, which include like a prohibition on confessions of judgment and certain other requirements and prohibitions. We do not have rules in place, including registration, so they are not yet subject to the registration requirement or other rules. That's kind of what we're talking about putting into effect.
And Matt, if I can jump in and ask a question too. This is Leslie Pettyjohn again. So as I see that, businesses are making some the sales-based financing providers are making some adjustments to their practices after September 1st. And we would be interested in hearing about how those practices have changed, how are companies redesigning their products and changing their billing, I think was what was commented in the question, that they believe complies with HB 700. So some of that information we would like to hear from companies about what adjustments have been made in the industry since the passage of HB 700. So we would like to receive some of that information as well.
Yes. Yes, that would be a great thing, some great information to get from stakeholders. Okay, so follow-up question from Danny J. We pull with an ACH schedule of weekly or daily payments. What would be the proper way to do a merchant cash advance while adhering to the automatic daily or weekly debit ban? As far as what's the proper way, that's kind of something we're interested in getting feedback on. But yeah, under the bill, there's a kind of like we've been talking about, prohibition on automatic debits without a first priority perfected security interest. So if you want to do automatic debits from an account, there needs to be a first lien perfected security interest. You might want to, if you've got questions about whether your particular transaction that you're engaging in meets that, you might want to check with legal counsel or take a look at that. But when we look at, as far as looking at regulatory requirements, if stakeholders have kind of feedback on what the rules should say on that, we're definitely interested in that feedback. Question from Matt Price. Can you explain the practical application of the law related how a sales-based funding provider can facilitate collection of funds? An automatic ACH is prohibited, even if first position security interest is established. What is the OCCC recommended and compliant collection process? Great question. And again, something our starting point is the text of the statute. So the legislature has placed this requirement in effect. We cannot change the text the legislature has put into effect. We may be able to specify some details about compliance. And this is really, we're trying to get information about some of those practical effects. Like, we want to learn more about the practical effects and what the rules should say or specify about that requirement from you, the stakeholders. So this is something where we're really interested in hearing from y'all about, what are these practical considerations and how do we implement this text the legislature has put into effect? What are additional items that we can specify in the rules consistent with the text the legislature has put out? So as far as the practical concerns, I mean, those in the industry, y'all are in a really good position to tell us what the practical effects would be to ensure that we can have a rule that's informed by that. Okay, it sounds like we have another hand raise. Oh, we have a few hand raises. So let's go back to the hand raises for a little bit.
Matt, we currently have 4 hand raises, and I'm going to start with Mr. Plato again because I think we've got him sorted. Great. Mr. Plato, you should be unmuted.
Hey, can you hear me now?
We can.
Okay, a couple of things about comments mostly. First, as far as like they're saying taking like a debit every day, from my understanding, and attorney, it's the same thing. You're automatically setting up a debit from the merchant's account and you're selling them the future sales. So if somebody's already debiting, you're already buying the future sales and it will be a second position. The same thing as if somebody has a different bank account, you're still buying the business's future revenue. So if they want a broker, especially I go to Fair Practices, tells the merchant to open up another account so that the funder doesn't see it, that's also again a Fair Practices because you're trying to get around the law to do that. So there's really only way, and also the person brought up about bringing a portal. It still cannot happen because then they have to have access. I'm a funder. They would have to have access to my bank account with the bank for them to be able to stop or start the ACH, but it's still getting pulled on the ACH. So if somebody's already buying the future sales, and I've been doing this for 13 years, there wasn't many other third, fourth, fifth positions to take. And to get the way to, I don't want to say get around the law, is what we've been doing for 10 years is a real purchase under sales where you pull it from the credit card sales. So there's no automatic debit. It's coming as a percentage of the credit card sales. So that's a way to which our attorney said is a way to circumvent the new rule because you're not automatically debiting it because that's what it states, an ACH debit.
Okay, that is, thank you for that. That's really helpful. Do I understand correctly that is this part of like the processing of a credit card payment? Like when the consumer, at the time the consumer pays, does some amount go to the provider, or does that amount come to them afterwards?
No, well, some funders will do it where when the merchant ends their day and they batch their credit card sales out, it would hit their bank account and then they will go in and they will pull that amount from the bank, which is still doing an automatic debit. It's just a different amount. The real way to do it, when I first started doing MCAs like 13 years ago, when the merchant batches at the end of the day, if we're taking 20%, let's say their daily credit cards, they batch out $1,000. The processing company would send us $200 and send the merchant $800. So it doesn't hit their bank account. So it's not getting automatically debited.
Okay. Okay. Got it. No, yeah, these kind of practical examples are very helpful for us. So we we encourage y'all to provide those to us either in this webinar or in your comments. So thank you for that.
And
I'm sorry, I think I accidentally unmuted him. Let me make sure he didn't have anything additional. Mr. Plato, are you still there?
yeah, that it happens. That's okay. I lost my train of thought for a second though. I would say no. I was agreeing with the rule what they're doing because like I said, I've been doing this a long time. Like I say, when people they shouldn't do it where you cannot have more than one because some people can't afford it. Sometimes you have people like they should do it for the affordability. Where if somebody like I see these funders giving people these merchants taking 12 different MCAs, 12 different payments a day coming out of their bank, giving up 60% of their revenue that they can't afford, which I agree with this 100%. For practices, I've seen merchants tell me they got a fake contract that they're going to get a 5-year loan if they take a deal for 2 weeks. So things like that, I agree with 100%. But for merchants doing $300,000 a month, they only needed to borrow $60,000 quickly. But then a month later, machine breaks, they need another 40,000. They could afford it. It shouldn't only be about just having just more than one lien. Should have it as something like affordability of what the merchant could afford. Because we're very responsible. We use our own money. We've given people 2 or 3 positions, but taking a certain percentage of their gross based on their profit margins, based on how much they keep in the bank, and not take more than what they can handle. So this is actually going to hurt a lot of businesses that maybe need that extra money but can't get it in Texas because the government said you can't have it.
Okay. Well, and you brought up underwriting practices, and we are definitely interested in if there are kind of standard underwriting practices that providers have in this industry, and if to the extent that that bears on, you know, unfair or abusive practices, if stakeholders have comments on that, that's another area we're definitely interested in, is those underwriting standards. So I definitely appreciate that.
No problem. I mean, it should be not just Texas, it should be throughout the country. Because some of these practices that I've seen where people are put out of business, like I see the lady said she does 83,000 a month. She's paying out almost 60,000 a month in revenue based sales based financing.
Yeah.
So
Okay.
they should be like me, but I appreciate you letting me speak.
Sure. Thank you.
All right. We have 3 additional hand raises, Matt. The next one is from Solomon Goldman.
Okay. Mr. Goldman.
Mr. Goldman, you are currently self-muted. If you can unmute yourself and make a comment.
Yeah. So my question is regarding to the UCC perfected lien. If 2 funders come in simultaneously and both wire a deal the same day and file UCCs within a few minutes of each other, how do you determine who's actually in the first position? is it purely timestamp based, or is there another form of authentication? And second, in that exact scenario, are both providers still allowed to run debits?
Okay. Interesting question. And we welcome feedback. I'll probably say this a lot about these very specific questions. If stakeholders have feedback on that, my understanding is that is based on the first in time of filing with the Secretary of State, but there's a couple caveats on that under the Uniform Commercial Code, which in Texas we have adopted in chapters 1 through 9 of the Texas Business and Commerce Code. We follow this kind of UCC framework that folks, especially attorneys who practice in this area, may be somewhat familiar with. But yeah, I believe priority is based on first in time of filing, but the security interest needs to be perfected, which does require a signed security agreement describing the collateral. It's a very high level description of something that can get a little complicated. I don't believe there's a situation where two people would both have a first lien. So that's my understanding. Again, we welcome comments from folks, especially attorneys who deal in this area.
In addition to that, if none of the providers have UCC liens, is that still a violation if you actually run a debit?
If none of the providers have UCC liens, I think the statute says in order to make an automatic debit, there needs to be a first lien, a first priority perfected lien. So if there's no lien, I think that would be a violation because, yeah, it says in order to make an automatic debit, there needs to be a first priority perfected lien. And in order to have a perfected lien, there needs to be a lien in the first place.
Perfect. Thank you, guys.
Okay. Do we have any other hand raises at the moment?
We have 2 more hand raises. The next one
Okay.
is Mr. Robert Zadek.
Okay.
Mr.
Zadek?
Zadek, you are self-muted and can make a comment.
Yes, thank you. If I may, the dialogue that was offered on the UCC filing lien, I think during this webinar was inconsistent in one regard. An answer to a question about first lien on what, the answer was on the account, the bank account. That's what you had to have, the funder had to have a first lien on. And where people might have gotten confused is you do not perfect a security interest in a bank account by a UCC filing at all. There's no such thing. The only way to perfect a security interest in a bank account is by entering into a deposit account control agreement, commonly called a DACA, which means an agreement with the depository bank. Therefore, there is no, in that concept, there is no UCC filing to worry about. It's pointless. I just wanted to not have people leave the seminar confused. But as to my, I just offered that out. As to my question, I have 2 questions, once again, unrelated, which occurred to me during the presentation. The first is, there was, in the presentation, there was a prohibition against charging fees that are not disclosed. And when that was presented, I asked myself, disclosed when, specifically? And it's very, what I'm going to describe is fairly common. An agreement is entered into, and the agreement discloses all the fees. During the course of the relationship, the merchant makes a request for something, an extension, something, and the funder says, sure, we will honor your request. You're not entitled to it. We'll honor it, and we will charge you a fee. And they prepare and sign an agreement, which is like contemporaneous with the charging of the fee. That's not a fee that was disclosed at the time the contract was entered into. If the fee is charged like 1 second after the agreement is signed, is that run afoul of the statute? It's not clear the timing of the charging of the fee and the disclosure. That was my first question. And the second question is on the deposit account control agreement, which now becomes mandatory, since that's the only way you can perfect. In every single deposit account control agreement in the country, the funder is given has an agreement which constitutes a first lien, but there is always 100% of the time a carve out where the bank says you can have a first lien, but it's junior to our right to charge some fees for running the account. And that's universal. It's in every single case, which means in every single deposit account control agreement, even the most perfect one, the funder does not quite have a first lien. It's behind the bank for little bits of money. Does that comply with the statute or violate? And if it violates the statute, no one can ever get a first lien on a deposit account. Impossible.
Okay. Those are, again, very good feedback on the kind of practical effects of this. So yes, information, if stakeholders can provide us information about what you're saying are these control agreements that are going to govern the first priority, and is there, like, what would it mean to have first priority, what the statute says, what the text the legislature passed, what would it mean to have a validly perfected security interest in the account with a first priority against the claims of all other persons? That's helpful feedback to have. The question about disclosure timing, I think some of that ties into when we look at the disclosure requirement in House Bill 700, there is a requirement to, and this ties into the question about disclosing the fees, but I also think it relates to the bigger question of the disclosure, because there's a disclosure required if a provider extends a specific offer of commercial sales-based financing of less than $1 million, the provider shall disclose to the recipient the total amount of the financing, the disbursement amount, the finance charge. One thing we could address in the rules is the timing of that disclosure. And I think that might get to the kind of question about when the fees need to be disclosed, because if we can describe when that disclosure needs to be provided, typically when our agency looks at disclosures in the consumer finance areas we regulate, the disclosure needs to be provided before the contract is signed, before the agreement is entered by the parties. But that may be an area, that kind of timing of the disclosures may be something, if stakeholders have input on that, could be something to clarify in the rules.
Matt, we have 2 additional hand raises. It also looks like we have a significant number of written questions at this time.
Okay, I'm gonna switch to written questions for a little bit and get through a couple of those since we built up some written questions. So a question from Jean Rosen, comments in relation to the question whether the new law affects prior transactions. Section 16 of Article 1 of the Texas Constitution states, no bill of attainder, ex post facto law, retroactive law, or any law impairing the obligation of contract shall be made. In other words, a law cannot impair a contract made prior to its effective date or a contract made prior to September 1st in the case of this law. I would generally agree that laws are prospective in effect and affect transactions on or after the date of the law. So if stakeholders have thoughts about how this affects what we say in the rules, we encourage that. Although with the rules themselves can, they also have prospective effect on activity on or after their effective date. Question from Brianna Cook. 1, will HB 700 apply only to sales-based financing agreements entered into on or after September 1st, 2025, or will agreements that were executed before that date also be subject to the new usury, registration, and disclosure requirements? So again, generally my understanding is the laws apply to transactions on or after their effective date. And then registration has a different effective date from the effective date of the bill. So that's something to look at in the text of HB 700. Second question from Brianna Cook. Specifically, if a company has agreements that were executed prior to September 1st, 2025, and is only collecting payments on those agreements and not issuing new agreements after that date, must those earlier agreements comply with HB 700 provisions like the usury limits and disclosure requirements? So the again, the law, we understand the law to have kind of prospective effect to apply on to transactions on or after September 1st, 2025. But again, that's kind of outside the scope of this rulemaking, since some of those transactions are going to fall into a period before the rules actually go into effect. So I would welcome feedback from stakeholders on that. We could, if there's interest in having a rule specifying the effective date of the requirements, that's like a kind of temporary provision, and stakeholders have thoughts about what that should say or specify, we encourage you to file a comment on that issue. Question from Jose Gonzalez. A lot of feedback I received from a few funders have opened foreign entities in Utah and other states. Is that something to explore? How does this work around those restrictions? So I was looking at the text of the bill. The bill does specify that it applies to providers and brokers who provide services to recipients in this state, regardless of whether the provider or broker maintains a physical presence in this state. So the text the legislature adopted was that this applies to extensions to recipients located in Texas. A written comment from Scott Plato. To comment on the UCC filing can go back to fair practice. That goes to the broker for setting that up. If two UCC filings at the same time. Okay. Question from Gene Rosen. Will the OCCC be publishing an official form for the disclosures required by this law? Great question. The statute doesn't talk about adopting an official form for the disclosures. It talks about the disclosure having required elements. So we're still thinking about that and considering it. A model disclosure form or some sort of official form could be a possibility If stakeholders think that's a good idea, that's something we're still considering. Typically, if we adopted a model form, there would be, we wouldn't just want it to be a totally optional form. We'd want it to be something that providers are expected to use in practice with limited changes. So if we were going to adopt an official form, typically we would adopt that and then have a limited set of permissible changes to the model specified by rule. So that's typically how we've done things in the past when we take a look at model disclosures. We've used both approaches, the approach of having a model with a limited set of permissible changes, and we've also used the approach of having just specified elements. So it's something we're still considering. We welcome feedback on. Okay, question from Zalman Notik. To clarify, the debits are set up by the merchant and with them being in control, meaning the merchant cash advance provider isn't setting up any recurring debit. The merchant is choosing their form of payment and their schedule. Okay, good feedback. Jose Gonzalez, credit card splits don't collect via ACH. Is this a good way to work around this? And how does it affect it with multiple positions already in play? Okay, so again, we're interested in learning more about these credit card processing splits. Again, that could, you know, do stakeholders have thoughts on whether that is an automatic debit? Kind of goes to how do we want to define the term automatic debit of a deposit account, and should that apply to these kind of credit card splits? Definitely want feedback about what's happening in practice and how do stakeholders think we should kind of cut those requirements as far as what those terms mean. Question from Jean Rosen, additional question. Given that the statute is currently in effect, but we do not yet have regulations or a form for required disclosures, are providers currently expected to be making a good faith effort to provide a form of disclosure to recipients in connection with ongoing commercial financing transactions? So I would say the safest course for providers would be to disclose that information that's described in the bill for transactions on or after September 1st, 2025, since the requirements are already in effect. And, you know, Jean Rosen used the term good faith effort. I think, you know, that would be kind of the safest course would be to make an effort to disclose information for transactions that the law currently applies to. That would probably be the safest course for providers. Question from Kobe Adams. Hi, thank you for your time today. A, please define deposit account. B, can a client set up future checks to be deposited daily going forward? So again, deposit account may have some definitions we could look to. That may be a term that could be defined in the rules. If there is a kind of preferred definition, I think someone mentioned that term being defined in the UCC. If stakeholders could have preferred definitions that they could refer to that we could specify in the rules, we would welcome that feedback. Can a client set up future checks to be deposited daily going forward? I think that's getting to these questions around what is automatic debiting. So that would be good to get feedback on. Do stakeholders consider setting up future checks? Now, when you say future checks, that starts to sound like a kind of recurring thing that might be automatic. So when we get comments on what is automatic debiting, future checks or recurring debits, you know, might start to look more like an automatic debit. Definitely something we might address in the rules and are interested in feedback on. Question from Alan Pollock. Can a funder fund a merchant from a non-usury capped state, put a choice of law provision that the law of the funder should apply, and have a Texas court enforce this agreement as a way to comply with the prohibition against automatic debits? The funder is actually located in the non-usury capped state, and their presence is not a farce. Okay, choice of law is interesting and complex issue. Again, I would defer mainly to the text the legislature used. The Chapter 398 applies to a provider or commercial sales-based financing broker who offers financing services over the internet or for a recipient of this state, regardless of whether the provider or broker maintains a physical presence in this state. Choice of law is a complex issue, but I think our agency's primary expectation is that if you're extending this financing to someone located in Texas, the company would be subject to these requirements, but it's a kind of complex area. That's kind of the general expectation. Question from Ashley Ward. We're getting a lot of written questions. I'll try to go back to hand raises after this one. Ashley Ward, are they still able to daily debit? I don't understand how they can debit daily or weekly with the new laws. Okay, so this is getting to a kind of key issue, and this is where it's really helpful for us to get feedback from stakeholders, because this prohibition on automatic debits without a first lien perfected security interest sounds like we have a lot of interest from stakeholders on the practical effects of that. And that requirement was put in place by the legislature. That is what the law says. We're interested in getting feedback if stakeholders think that, you know, that has practical issues in implementing. We want to know about that and hear more about that. I will turn it back to hand raises for a few minutes. Audrey, how many hand raises do we have?
We currently have 2. The next one is Alec Schwartz, and I am going to unmute him now. Mr. Schwartz, you should be just self-muted.
Yes, thank you. It's Alex, actually, but Alex. So first of all, I wanted to thank you for this opportunity as a stakeholder. It's really important to be able to comment and have an open discussion. The second, I just wanted to raise something. I understand that, you know, the law is written and you have to now create rules and regulations for it, but you know, responsible underwriting and also with proper reconciliations for this product will now be limited by this just first UCC position, because if you're actually reconciling sales and only debiting the reconciled amount from merchants, by only allowing first UCC positions, you're limiting these merchants to access to capital that they might need. Businesses grow. You know, you might have a merchant that's doing certain sales today, and 3 months from now they're successful and their sales are growing and they need access to more capital, but now they are, you know, drastically limited because of this first position UCC. I don't know if that's ever going to change, but I think that that's something that should be looked at. Certainly if the merchant is having hard times and sales go down, and due to the reconciliation provisions, they might not be able to afford another position, but they should have the opportunity to go out and obtain more capital if they're doing well. And I just think that a lot of businesses are going to be limited to access to capital because of this first position language. Thank you for allowing me to speak.
Okay, thank you for that comment.
Okay, we have an additional hand raise from Alan Garza.
Okay.
Mr. Garza, you should only be self-muted at this point.
Yes, thank you. Thank you for allowing me to speak. we are definitely for HB 700, and we're excited that this has moved forward. I've had the pleasure to be able to speak along the process of this bill passing and to share my story and experience with, dealing with MCAs and kind of, as a small business, I'm a small business owner out of San Antonio, Texas. We're based on utility construction services. And along that way, this industry is up and down. And we were in a position where we had to take loans here or take loans there or try to find ways to make it, right? It was never easy. And so I have more like two comments I want to make. One is, just the consideration of maybe a limit on like the interest that some of these MCAs charge and ask for, because we've come across so many different MCAs that are offering, like, they put us in a position where we have to take a super high interest rate because maybe all of them that's where the market is, and so everyone's just okay. Hey, you put your you put your interest rates at this rate, so the market goes super high, and it leaves us in a bad position to where we're just spinning our wheels and we can't even get out of debt. That's one thing that I'd like to share. But the other is the experience of kind of getting trapped in the middle of a situation we had nothing to do with. My uncle, Christian Guerrero, out of Abilene, Texas, he's also a contractor out there. And it's a totally separate entity, separate company. We have nothing to do with each other's companies. But somehow along the way, he got a loan out from an MCA merchant. And, they did their deal. They made their agreement. I had nothing to do with it. And then later on, when I went to go looking for funding, I found out that there's a UCC filing on my company. And for the longest time, we had to investigate and figure out where that was coming from and why this is even on there, because I haven't taken no money out. And it goes back to end up happening that a company that my uncle did business with to got a loan out, the LCF group, ended up putting a lien on my company as well. And so we spent over a year and trying to ask them to, kindly remove it. We have nothing to do with this. We show proof. I'm not on my uncle's company, nowhere to be found. I have nothing to do with it. And they do not resist. And they try to use me as leverage to try to get my uncle to pay their bill, right? And so my uncle's back trying to say, hey, well, get my nephew's companies off this UCC filing, and then I can pay you type deal. And so they're going back and forth. At the end of the day, that UCC filing is still on my company. It's been over a year. It's pretty ridiculous how people can just, or companies can just kind of do what they want. And kind of, we get the bad end of the deal. Us being a small business, trying to make it in a market that's so tough. And obviously we know how the economy is. And having to deal with, we call them, loan sharks and them leechers that just trying to take you for every dollar. And so those are my comments. We appreciate this opportunity to speak. We hope, things continue to get better to prevent things like this in the future.
Well, thank you for that comment. Those experiences are really helpful for us in understanding kind of the background of this industry. So we really appreciate that. I would say the bill HB 700 prohibits adopting a maximum annual percentage rate, finance charge, or fee, but it does authorize kind of specifying some of these unfair or abusive or misleading acts or practices. So we're definitely interested in some of those experiences and how those could bear on possible prohibitions. And the example with the UCC filing based on a transaction entered by the uncle's company kind of makes me think of maybe there's something around getting an authorization for a security agreement from the right person. But yeah, definitely interested in any kind of policy suggestions coming out of that in the possible or in the future rulemaking on unfair and misleading practices. So thank you for that. Do we have any other hand raises at the moment, Audrey?
Yes, we do. Scott Plato again, and I'm going to unmute him now.
Great.
Okay, can you hear me again?
Yes.
Yeah, I just want to make a comment on that last guy. He's trying to make this whole industry look bad on the light. One, if his uncle had a judgment that they might have went into his process, his uncle didn't pay. Unless LCF is a company just scumbags, which some companies are. But the cost of it, like I'm a funder, my cost is based on the risk of people. I tell them what you make it, because if they don't pay us back, and we could charge them 1% or 5,000%. If they take the money and run, we're out on money. We have to make up for it. Just like with him, if he charges his customers, it costs, let's say, $5,000 to do work. He charges them $13,000. His cost is a lot more than my cost. And they're using this money to grow their business, to make money with it. So if I'm charging somebody 35% for 8 months, they write it off. They want them paying only about 25%, but they make 500%. How is that criminal? How is that high cost? Is that Michael would only put a file a judgment against the business if they don't reach back to us, they don't talk to us for months. What I do is, so there are bad companies, like I said, the regulation for, like I said earlier, to get all the practices and everything else is good, but he can't put everybody in the same bucket. Just like you have contractors they have TV shows about bad contractors and taking advantage of people. So does he want to put himself in that same bucket? Like he's putting like companies like mine that do the right thing, that was featured on Shark Tank, which wasn't easy to get on. We have an A+ rating, putting us in the same bucket as an industry that we need to get regulated and make less money. If it wasn't for this industry, with banks not lending for the last 20 years, our economy would not have had that 20-30 trillion dollars lent if it wasn't for this industry. So that's why I would say I hate when people talk about our money's expensive. When people because when people don't pay back and they want money that's cheap, they're not going to get money. So there's a need for merchant cash advance. There's people that talk bad about it. Are the ones that probably had bad experiences because they did bad.
Yeah. Okay.
That gets me when people are talking bad about what we charge because of other people. Just say your experience and what those people. Don't say that we charge high money, because if you look at a bank, my bank is charging me 43% for my car loan with my car's collateralization. I have business owners that have been with me for 8 years and paid a total of 37%. Who's worse, a bank or me?
Okay.
But yeah, it's a great industry. It's the companies like LCF. If they actually did put a lien on his business and he had nothing to do with it, and his uncle paid back on time, then it's for people like that. For people that do the right thing, the government's killing us to help these small businesses that actually help them in order to get the money they need to grow their business when banks won't give it to them.
Yeah. Well, yeah,
Mr.
I think.
Oh, go ahead, Matt.
Yeah, I was just going to say, we really appreciate the feedback on how the providers think, what providers think doing this right looks like. What does a successful transaction look like that, can be repaid by the recipient business, and how, when we want our rules to be in a context where these parties can have a successful transaction. So let us know what we can do to ensure that these transactions are successful.
I have a lot of things I can say about it, but I don't know if the government's going to want to listen to me. Because I've been in finance for 30 years. I was a Wall Street broker. I was a mortgage broker with my own office. I've been doing revenue-based financing for 13 years. That's everything else. So there's a lot of things you can do that. It's just, like I said, it's the bad companies that take advantage of these merchants is what brought these people in. It's why states, it's not just Texas. Virginia is also passed laws where that we have to disclose as a funder how much the broker's making. Charlotte, Florida has, and New York has state disclosures we have to have signed. So it's not just Texas that is coming in to try to regulate this industry. It's a lot of states. Texas has just made it worse as far as only making one advance, which like I said earlier, it's good because those people that are taking 10, 12 advances because they put themselves on a hamster wheel, and if they don't take more funding, they can't afford to pay those other payments and still survive. So that if they don't get that funding, they're either defaulting or they're going out of business. That's why, like I said before, they need regulation on to sit down with people that are like my company, that are funders that actually do the right thing and try to come up with some type of laws stating based on, like I said earlier, gross reserve, profit margins, and everything else.
Yeah.
And then that would help out because, like I said, another guy said earlier, is like handcuffing people that if they took this money and they have it first for 15 months, but in 4 or 5 months they grew their business, they need more inventory and they can't get their hands on it. What are they going to do? Or they can afford it, but let's say it's construction and one of their big piece of equipment breaks and they need 10 grand to fix it, or a trucking company. They're very expensive to fix, and they need 10 grand to fix, and they already have a UCC filing. They don't have that much money extra to bank to put out. How they're going to fix that truck to keep it on the road?
Yeah.
So they need to sit down and look at stuff like that. I wish that there's a forum that I could talk to that I and that's what other good companies could talk about to try to change this law a little bit.
Okay.
But I appreciate the time again.
Thank you. Thank
Mr. Plato, before you wrap up, I wanted to ask you, you've sent me several direct messages and I want to make sure those were covered by your comments just now.
Well, just pretty much commenting on some of the stuff that like people were saying that I want to keep on like talking. Like I said, one of the issues earlier that I mentioned when there was money brought up about if somebody was, which we call double funded the same day, and each funder does a UCC filing, who has it, that goes down to back to fair practice of the merchant with the merchants, I mean the brokers, because the funders won't know. Like I said, we don't know when we're funding somebody that they're getting funded the same day. We've had that happen where we do a merchant interview, we do a bank verification, there's nothing, we find out later. That's a lot of times it's the broker that's telling the merchant to do it in order to take 2 first positions to get a better deal and have 2 payments coming out when the funder doesn't know. Sometimes they lie to the merchant and they don't think they don't know it's a bad thing. Sometimes the merchants know too because they've done this before. So that's it. So there should be, and then, but thing is that then that comes down to us, that like before, who's got the first lien now? If we do it, then it should be both of us should have the first lien if we found out that we were, and then go after the broker to pay us back because they're the ones who facilitated it. And if the broker, and they could find out proof that the merchant knew about it, then they make them pay for it, because how does a funder know that they got funded the same exact day?
Yeah.
That was my question. And I think what the other one is, and the person asking about, what's it called? How can we do a second position in Texas as an ACH? You can't. It specifically states that you can only have one ACH pull.
Yeah.
And then going back to, I just remember the deal that I just funded as a credit card split because he had no automatic debits coming out, but the guy has several different companies. The funder, because it was right before the law, put a UCC filing on 5 of his different companies for one taking the merchant to money from one funder. For his one business with separate tax IDs, but he cross collateralized everything so they could be in first position. So if they need money, they can only go to them, which goes back to, again, fair practice. They try to lock this guy in so that he cannot, they try to do monopoly so this guy cannot go elsewhere. This is, again, back to why we need regulation.
Okay.
But again, I appreciate the time to talk.
Thank you.
Thank you. I just wanted to make sure we covered all of your comments.
No problem.
All right. I'm gonna go back to some written questions for a few minutes. So from Jose Gonzalez, would making direct online payments via a portal, parentheses, debit card, auto debits on a debit card work to collect versus an ACH? So again, this might kind of go to some definitions around deposit account. I think at kind of a high level, I understood debit cards to access deposit accounts. So auto debits on a debit card could be automatic debits of a deposit account. But again, that kind of goes to if stakeholders have a preferred definition for deposit account that we should incorporate into the rules. We're interested in hearing about that. Question from Jacob Neiman. It should be clarified that perfection of a security interest in a bank deposit account requires control, not merely filing a UCC-1 financing statement. Typically, this requires a deposit account control agreement. Okay, so that, again, we welcome feedback on that, especially folks who deal with this area of the law. If you have legal citations or kind of background on deposit account control agreements, we'd be happy to see that in informal comments. Jean Rosen, after the conclusion of this webinar, what would be the best way for stakeholders to get in contact with the OCCC regarding questions and comments regarding proposed rulemaking? I think the immediate way to provide feedback would be to, and we'll include this in the final slide, but we are taking informal comments sent by email to rule.comments@occc.texas.gov. So I think that email address is a good resource. We strongly encourage everyone to provide any informal written comments by end of day tomorrow to rule.comments. Israel Reches, Matthew, I think it's important to note that based on this conversation, the OCCC has not given guidance on the term account yet. We don't know if the first position is in the bank account or in the account receivable. Yes, it sounds like we've got a lot of interest in the future rules that we're working on. We don't have a draft of the rules yet. We'll be working on a draft and have a proposal out in the future. But it sounds like there's a lot of interest around the terminology in around automatic debits and deposit accounts. Yeah, sounds like a lot of folks are interested in the rules providing guidance on that issue, and this is an opportunity where we're having the conversation about what the rules should potentially look like right now. This is a great time for folks to share thoughts on what that should eventually look like. But yes, that's correct that the OCCC has not given guidance on it yet. That's kind of the stage we're at the rulemaking process, where we're having the conversation about what the rules should ultimately look like. Emil Benjamin, do all entities listed on our UCC need to be first UCC or only the businesses we plan on debiting from? Sometimes we have additional entities that we only plan to go after in case of default that may already have UCCs. Okay. Again, we're talking about a prohibition on automatic debiting, except for those accounts for which there's a first lien perfected security interest. That doesn't address things other than automatic debits. Additional entities we plan to go after, I guess I may have a follow-up question for Emil Benjamin, which is, and this could be in a follow-up written comment, or if they want to raise their hand. Do you have security agreements from each of those entities consenting to a security interest in the collateral owned by those other companies? It's kind of making me think of the nephew-uncle example, but if Emil Benjamin wants to provide a follow-up on that, that might help. Melanie Cook, is there a violation if the borrower sends funds directly to the seller, i.e. through ACH, Zelle, Wire, etc.? I think that's getting at, again, this concept of automatic debit, and is directly initiating a transfer an automatic debit, or is that more like something that someone's manually initiating? I could kind of see the rules having a distinction between something a recipient just does manually and something that is delayed or recurring and is therefore automatic. But I'm interested, you know, where should the rules draw that line? Alan Pollock, to be clear, in this case, the funding is a loan, not a MCA agreement. Okay, I'm not sure which Alan Pollock question that was referring back to. Oh, Alan Pollock was referring back to the choice of law question. And that, okay, so non-transactions other than sales-based financing are kind of outside the scope of what we're looking at now, and get to commercial loans that the OCCC might not necessarily regulate. So that might be a little bit outside the scope of what the OCCC would be looking at. If you're talking about commercial loans from out-of-state lenders that are not sales-based financing. Okay, going back to the questions, Emil Benjamin, also with regards to the Utah method, someone mentioned, I believe funders are switching to loan agreements to skirt the Texas sales-based financing laws and funding with companies in Utah to skirt the APR ceiling. Okay. Comment from Melanie Cook, a credit card processing split is an agreement entered with the processing company where the processing company holds back the agreed upon percentage of purchased receivables. They send the held back portion directly to the seller, and the, oh, just a moment. I need to look at my PowerPoint window here. Okay, thank you for your patience. They send the held back portion directly to the seller and the remainder to the borrower merchant. Alternatively, the seller can enter in a lockbox agreement where the previous day's credit card batch is deposited into a lockbox, and the lockbox account splits and disperses the fund. Direct credit card splits are not as common as they used to be. Okay, again, very helpful to have those details about the practicalities of the transaction. Matt Price, it appears stakeholders understood most of the requirements of HB 700, and we are also adhering to similar mandates in other states, such as registration and disclosure requirements. That said, most of the questions are focused on how a sales-based financing provider can practically set up collections of future sales without the ability to ACH accounts. If that can be addressed and clarified, that would help stakeholders' ability to navigate the regulations effectively. Okay. That is something we can consider. And again, the provider, well, the providers and the users of the product, you know, y'all know best what the practical realities are. So we're definitely open to hearing about that. Okay, from Scott Plato, the merchant should be signing the ACH authorization form and the contracts from the funders. Okay. Good piece of feedback on that one. Okay, I've gotten to the end of the written comments that I see. Audrey, do we have any hand raises at the moment?
There are no hand raises.
Okay. Well, thanks everyone. Now, if I was scrolling through a lot of written comments, so if I have missed a written comment, please type a quick message into the questions area so that Nico or Audrey can direct me to a written comment, or if you want to like retype your question. I just want to make sure we've addressed all written comments at this point. I'm going to allow another minute or so for folks to put in any additional written comments or questions, or for anyone to raise a hand. So I'm not
Matt,
seeing any. Yes.
We do have a hand raise.
Okay, great. Could you go ahead and unmute? Yeah.
Mr. Yosipov, you are unmuted.
Hi, Manny here. I just had a quick question about whether or not you guys will be able to send out a transcript of this webinar.
Oh, we are not planning to transcribe the webinar. But the webinar will be, the video of the webinar we will plan to post to our agency's YouTube page.
Okay, thank you.
Yeah, and that'll include the audio. Yeah.
Perfect.
Okay.
I have no additional hand raises at this time.
Okay. Okay, I'll wait 1 minute while we wait just to see if anyone has any other written questions or hand raises. Again, if you have a long written comment and need to take some time to type that out, you feel free to send a short message. Or if I skipped any written comments, please let me know in the chat. Okay, I am not seeing any additional, sorry, we do have one. George S., when can we expect the video to be posted? We'll try to get it posted in the next couple days. And Israel Reches, thank you both for your time and willingness to listen. I do have an update. There was a question about the transcript. I will say when we post the videos, our YouTube page does have an option for closed captioning. So that can, there's at least a closed captioning with the YouTube video. Oh, we have a question incoming. Sam Gross, is there any exemption if the contract is above a certain dollar amount? Okay, great question. There's, I believe HB 700 has an exemption for the disclosure, the required disclosure of transaction terms if it's over $1 million. But there's no, excuse me, if it's $1 million or more. So the disclosure of contract terms is for transactions of less than $1 million. But other than that, there is not in HB 700, there's not like a general exemption based on dollar amount from the requirements of the whole chapter. So yes, for disclosures, but not for the other transactions. Also, I should say the exemption for car dealers is can be based on dollar amount. So if you're relying on the car dealer exemption, I would take a look. That's referring to sales-based financing agreements or commercial open-end credit plans of $50,000 or more with a licensed car dealer or a motor vehicle rental company. So if you're looking specifically at the car dealer exemption, that does have a dollar amount. Great question. Okay, I don't see any other questions. So thank you. We really appreciate this kind of feedback.
Sorry to interrupt. I got
yeah.
one more question incoming from Mr. Gross. I'm going to post it to the chat real quick.
Okay, sure. Yeah, absolutely. Okay, question from Sam Gross. Can we do one-time debits with merchant's approval? Okay, so again, I think that gets to possible definition for what is an automatic debit, and should the rules draw the line between things that are recurring or kind of in the future being automatic, and kind of more one-time things not being automatic debits. I could see the rules possibly addressing or specifying that, but yeah, that's something we will be looking at, and we welcome feedback on if there's a suggested way to define what is an automatic debit. But I think that question ties into the question about one-time debits with merchant's approval. Okay, I'll wait a few more seconds to see if we get any other hand raises or written questions. Okay. So again, really want to thank everyone. We really appreciate everyone's feedback and participation. We do have rule updates available on our website, on the OCCC's webpage for recent and upcoming rules. And like I said, we'll be posting the video and audio of this meeting to the agency's YouTube page. We are accepting informal written comments until 5 p.m. tomorrow, November 20th. Please email those to me at rule.comments@occc.texas.gov, which is our email address for rule comments. Thank you all for attending. Please be safe out there, and we will see you next time. Thank you.